Okay, what a turn of events, right? There's no stopping this market sell-off. The Nifty is now down almost 300 points and it's quite rapid, the kind of fall that we've seen. There's nothing to really explain it. There's no major reason for the sell-off. It's just perhaps some profit-taking after a sharp run-up. Shibani Sircar Kurian, who's the Senior EVP and Head of Equity Research at Kotak Mahindra AMC, is joining in. Shibani, a surprise turn of events, right, in the last 1 hour or so. I don't think anyone would have expected the severity of this fall. But be that as it may, how does one approach it now?
Hi, good afternoon, Sonia. Yes, so we've had a tremendous rally over the last month or so, and therefore some amount of profit booking could possibly be explaining why we've seen this turn of events. But having said that, if you look at our markets, three key things have been driving markets. One has been the fact that India's macro growth outlook is significantly better than the rest of the world, especially the emerging market pack. Our earnings has been holding up much better, and in fact, after the first half, the ask rate for the second half of the year in terms of earnings seems to be pretty much achievable, and therefore that is what is also helping markets. And domestic flows have been quite strong. And despite all of market fundamentals, when you look at FIIs in terms of their holdings in Indian markets, that is at a decade low. So therefore, markets have been clearly supported from domestic factors, and even from an earnings perspective, domestic facing companies appear to be better placed. Now comes the question of valuations. And what we have been really saying is that when you look at large caps, valuations are not still in that expensive range. They are slightly above long-term averages, though mid caps and small caps in terms of their absolute as well as relative valuations are above long-term averages. And therefore, our view is that the overweight stance somewhat in terms of large caps where valuation comfort still exists continues. Now, within the mid-cap space, I must say that the earnings trajectory remains very strong. And therefore, one has to be just careful in terms of avoiding froth, looking at companies which have run up because of poor liquidity or where there is excessive valuation. But net-net, the earnings trajectory overall for the market as well as a broader market would likely help support, especially in the medium term.
Right. Shivani, your thoughts on some of the sectors as we speak. You did like a couple of these large cap IT names. They have done well over the last 2 weeks or so as well. And importantly, the outlook for the industry perhaps may improve given the Fed is looking to cut rates. Do you think it's a good place to be right now from a 1-year perspective, given that they've done nothing?
Yeah, so if you look at valuation comfort, large cap IT and large cap banks, these are two segments where there is clear valuation comfort. Firstly, in terms of large cap IT, as you asked, the overall near-term outlook remains fairly muted. Therefore, there are still no great green shoots that you're seeing in terms of recovery and demand recovery. But clearly, what has happened over the last 1 year is that the entire deal win momentum has been fairly strong, especially the large deal win momentum. And therefore, over the next maybe 6 to 12-month period, as these deals start to ramp up, you may start seeing some amount of that recovery. The fact is that interest rates are possibly at peak also help in that context. So we will have to wait and see in terms of recovery and what clients are saying in terms of their spends on budgeting for the next year. But yes, clearly from a valuation perspective, large cap IT at this point in time is possibly better placed than the mid cap space, which has seen a sharp run up, and now valuations are uncomfortable. So we would be selective on mid caps and prefer large cap IT at this point in time.
But mid-caps have corrected, right? Many of them are down 5-6%, some of them going up to a 7-8%. Is today a good day to buy into individual stocks or deploy lump sum money? SIPs are ongoing irrespective of market levels. But if someone is waiting by to deploy a lump sum, a one-time investment, is today a good day, or do you think we could see lower levels?
So, whatever we have seen today comes after a very sharp run up, and therefore it's not a very meaningful correction to that extent. We have always been advising that staggering investments is possibly the better way to go, especially where mid and small caps are concerned. Given the fact that over the last 12 months, we've seen this stupendous rally in the space, we believe that, as I was discussing earlier, that the earnings trajectory for many of the domestic facing businesses, specifically within the mid and small caps, remains strong. And therefore, yes, if there is a correction in the market, you would possibly use that correction to build positions in high quality, high growth mid caps when valuations become more comfortable. But staggering makes always a little bit of sense, and especially that this is today just a a small correction that you've seen after a very, very sharp run up.
Okay. Actually, some of these spaces, right, are doing very well. So, for example, the mid-cap IT space, I mean, the stock that we're seeing right now on the screen is Birlasoft. It's been one of the biggest movers this year. And a lot of these companies, these tech companies are going big in spaces like generative AI, for example, whether it's something like a Happiest Mind, Scient, etc. Any of these themes that you still like? If there's a dip, would you buy into any of them?
Yes, absolutely. So I think that, what's happened within the IT space is some of the smaller companies, mid-cap companies, because of their size, have been far more agile. Also, a lot of investments have been made in building capabilities in new age technologies, whether it be digital, whether it be AI, or even on the ER&D side. And therefore, what we have seen is that over the last year, while the sector has seen muted outcomes on revenue growth, some of the mid-cap names have shown faster growth. And this is a sector where typically multiples re-rate with revenue growth trajectory. And that's what's happened where some of the mid-cap names are concerned. However, at this point in time, given the very sharp outperformance, we've seen that in pockets, valuations have become extremely stretched. And therefore, while there would be pockets where we'll still be liking the company from their overall growth profile, we would possibly wait for better valuations as an entry point. And hence, at this point, we would be selective where some of the mid-cap IT names are concerned.
All right, Shibani, thank you so much for joining in and giving us your views on the market. As of now, looks like it is just routine profit taking. Valuations are still elevated, but some of the pockets do look good from a long-term growth standpoint, and in the near term, a couple of these IT names on account of valuations. Meanwhile, for the Nifty.
Thank you for watching CNBC TV18. For all the latest news and updates, do follow us on our social media platforms.